Hello, and welcome to today's session on IVICs, or Individual Variable Insurance Contracts, commonly known as segregated funds, but remember that the official name is Individual Variable Insurance Contract. And it's a very important statement because the contract is an individual contract, it's not a group contract, it's an individual contract, and is also an insurance contract. And so it falls under the Insurance Act. And this is an important distinction between basically a segregated fund. So think of segregated funds basically as the insurance company's mutual funds. So what we're going to talk about today is some of the distinctive differences between a mutual fund and a segregated fund. Now, there will be a number of more slides on this, but today we're going to talk and primarily focus on what we call the maturity guarantee, which is a very, very important part of the segregated funds. Okay, so basically the objective today is to distinguish it between different types of IVIC agreements, as we call it, or guarantees. Okay, what is the difference between a policy-based type of contract and a deposit-based contract, and the main differences between the two. In subsequent videos, of course, we will be discussing more details, some other aspects of it. But today we're going to simply focus basically on in this particular area. So the first thing we'll look at is that an IVIC, like I said, is an individual variable insurance contract. And there are two types of guarantees, what we call a maturity guarantee and a death benefit guarantee. In other words, what happens at maturity and what happens should a person die between now, let's say, and the time the contract actually matures. Okay, so death benefit guarantees are not subject to the same distinction between policy-based or deposit-based. In other words, there is a distinctive difference between maturity guarantees between the two different kinds of policies. But death benefit is death benefit, so it doesn't really matter whether it's policy-based or whether it's deposit-based. The death benefit guarantee are not subject to any distinction, because when a person dies, the person dies basically, and so it doesn't really matter. Where it does matter really is the maturity, and that's why this particular session talks about the maturity guarantee more than the death benefit guarantee. Anyway, let's move on. So the maturity guarantee of an IVIC basically is 10 years. Okay, essentially, for the most part, most companies today issue a 10-year from the last deposit, not from the withdrawals. In other words, withdrawals have no impact on the maturity date. Okay, only deposits have an impact basically, but withdrawals themselves do not change the nature of the plan. Obviously, it will obviously affect how much money you get at the other end, but it does not change the actual maturity date itself. Okay, so insurance company will basically look at the last deposit, and they'll say from the last deposit we'll add 10 years to it, and that'll be the anniversary date, you might say, of the contract. Okay, so the maturity guarantee basically it all comes down to this very, very important point. Every insurance company has what's called the minimum statutory maturity guarantee, which is 75% of your deposit. Now notice I said that it is of your deposit, so it's not of the growth of the plan or anything. So in other words, you gave me $10,000, I guarantee you're going to get no less than 75% of $10,000 at maturity, which, like I say, is 10 years from the date of deposit. Okay, so as it says there, the guarantee is not on the returns, but only on the deposit. And so really, when you look at it, when you're buying an IVIC basically, or a segregated fund, you're really only risking 25% of your money, because the other 75% is insured. Okay. Now, some companies may also give you a better guarantee. So some companies will go all the way up to age of 100. Sorry, I said age of 100, but could be up to 100%. Okay, but they can never be less than 75. So 75% is the statutory amount. Okay, but some companies can of course go up to 100% if they so do so, basically. So you can withdraw before the guarantee date are not subject to guaranteed amount. Okay, so in other words, any kind of withdrawals that you make, so let's say you have a 10-year maturity and the 7th year decided that you needed $1,000 or something or whatever, that's perfectly fine, but they're not subject to the guarantee. You must wait for the 10-year, for the actual guarantee to kick in. So if you take out any money before that, or if you cancel the contract before that 10th year, you will get whatever the value is at the date of withdrawal, and that's it. There's nothing else, okay? So in other words, you really have to go full term in this to make sure that the maturity actually kicks in, okay? Now, there are two types of maturity guarantees, the two types of policies basically that are issued out there. And once again, you should look at your individual company to see which one that they actually use and everything else. It's what we call policy-based guarantee and deposit-based guarantee. So let's look at policy-based guarantee first, okay? That's the first we want to look at, because that's the one that is a little more complicated than most, okay? So a policy-based guarantee basically says that, again, the example we're using is you deposit $1,000 on January 10th, 2000, and then you have a series of payments, let's say of $100. A policy-based guarantee is 10 years from the day of deposit to December 31st. So the first thing I want to draw your attention to is a policy-based guarantee is always December 31st. So it always goes to the end, so 10 years to December 31st at all times, okay? So therefore, the policy will actually go all the way up to 31st, in this case, 31st of 2010. So 10 years, the deposit, if you notice the deposit was made January 20th, January 10th, but in actual fact, the maturity itself is really December 31st of 2010, okay? The point is that despite the deposits happening on January 10th, in terms of the policy, the maturity date is still December 31st, 2010, and that's an important consideration to make sure your clients are aware of that, okay? Well, what about other deposits during that year? If you continue to make the deposits throughout that particular year, so let's say in February, in our example, you gave us another $100, February 20th, you gave us another $100. Again, because you put the money in the same year, you notice that the maturity still is the same. In other words, the maturity date hasn't changed. It's still December 31st, 2010. However, the big difference, and this is an important consideration, is that what if I give you money the following year? So now in 2001, you gave me $100 to deposit. So that was now your last deposit. Now what happens is that the maturity will be December 31st of 2011. So I draw your attention to the fact that it's 2011. In other words, if whatever amounts of money you're putting in during the year does not change the maturity date. But the moment you go into the following year and you put in any amounts of money at all, then the maturity date now shifts basically 10 years to December 31st of that particular year. So that's a very important distinction to make on all this. So here, what we're talking about policy-based is that the first thing to note is that it's always December 31st. That's the main thing to remember. In other words, there's only one anniversary date, not two or three, depending on your deposits and all this stuff. It's always December 31st, 10 years from the last deposit, okay? So what the insurance company is based in saying, when was the last time you gave us money? That's really what they're going to say. Let's look back and see when was the last time you gave us money. Based on that, we will do 10 years. To December 31st. So in our example here, if you deposited money in January 2001, the maturity date is no longer 2010, it is now December 31st, 2011, you see. And that's a very important distinction to make, basically. Okay? If all the deposits were made in the year 2000, the maturity date will never change. You see. That's to say, so monies that are given during that year itself, that's not a problem. They'll be just fine, right? But the moment you make a new deposit in the following year, then everything gets shifted basically for 10 years. In other words, the date does not change based on deposits in the same year, rather changes when you make deposit in the new year, and that's an important distinction. Okay, so on a policy based, the maturity date is always December 31st from the last deposit. So that's again a very important distinction to make. Okay. Now, the whole question of the 10 years, of course, is that, as the insurance companies is basically saying, and this is something you need to stress to your client, is that it is not short-term investment. It is a long-term investment, so 10 years. So if the client is only looking at short-term periods and everything else, then this is the wrong plan for them because they're going to be, besides the possibility of sales charges and everything else, they're only going to get whatever it is of value during that period, okay? So in other words, in order to get that 75% or that 100%, they must keep it till the maturity date. If they come before that, they can still get their money out, but the big issue, of course, is that they're only going to get whatever the value is. So that'll be no different than a mutual fund. It's essentially whatever the value is. So that's an important consideration to make. So let's move on now to the next type of guarantee, which is what we call deposit-based. Okay, so the first one was policy-based. The second one now is deposit-based. This will be a little easier to understand because in deposit-based, okay, it's exactly 10 years from the last deposit. In other words, you give us money now, it's 10 years from today. So a deposit January 10th, 2000 matures January 10th, 2010. You can see that's exactly 10 years. Whereas it's a policy-based, which would have been to December 31st of 2010. Here, in actual fact, it's the exact same date, basically 10 years down the line. So a deposit February 10th, 2000 matures on February 10th, 2010. You see, and so on. So each deposit, okay, basically, you might say you're buying a brand new contract, you might say. So you're moving the maturity date every time you make a deposit. So each one of your deposits will have their own 10-year maturity date. Versus a policy base, which is all basically 10 years from last deposit, December 31st. Here, it's every single time you gave us any money, we simply tag on 10 years to it, and that's it. So each one of these deposits will have, like I said, their own 10-year maturity. So when you take your money out, you may find that you're withdrawing different maturity dates. And that could work for some clients. They like the idea of basically withdrawing money over a period of time. Certainly can work for the client. That's not a problem. But you need to explain that to the client. So the maturity guarantee applies to each deposit. It's almost like I said, buying a brand new contract. That's really what we're saying. Okay. So each deposit then is tracked. Is tracked to make sure that it follows the 10-year guideline. Now, once again, during that 10 years, if they cash out, that's perfectly fine. But remember that they're only going to get whatever the value is at that time. So once again, in order to get that maturity guarantee, that 75% or 100%, whatever it is, they must keep it for that 10-year period of time. So once again, as I said before, these are not short-term investments, they are long-term investments. So it is important that you stress that to the client. Okay. So essentially, when you look at it, just to summarize this, the difference between a policy-based deposit-based is policy-based says, when was the last time you gave us a deposit? From that date, we add 10 years to it, and we move the anniversary date to December 31st. That's, in essence, what policy-based means. Deposit-based, on the other hand, says, when did you give us the last deposit? But notice that with each deposit, you actually move the maturity date every time you make a deposit. So it keeps on shifting all the times, okay? So you may want to take a look at the deposit base as if it was the fact that you're actually buying a brand new contract every single time. But obviously that wouldn't make sense. So that's why the insurance company will issue a policy. But remember that each deposit within that policy will have its own anniversary date. Obviously, it wouldn't make sense that every single time you make a deposit, the insurance company is going to send you a policy. You can have a stack of policies at that point, which will mean it may be basically meaningless. Okay, so they say, okay, here's your policy, but remember that you bought a deposit-based type of contract, so the end result that each deposit will have its own 10-year maturity date, basically. Okay, so a different way, you might say, to apprise the product is that there are two systems that they use. Policy-based is December 31st at all times from the last deposit, whereas deposit-based is always 10 years exactly to the date that you actually gave us the money. So you have multiple anniversaries. So note, you must know the difference between these two for exam preparations. You will get a question on the exam on either one or the other, so you must make sure that you follow this, because this will definitely be both on the certification exam as well as the provincial exam. So that is the end of today's session, and we will see you next time.